It's FOMC week on Wednesday. They pretty much made it clear that they're not going to raise rates. At least that's been the overall overarching narrative, is that they're going to remain higher for longer, or remain, how did they say it? Remain high for longer. They quit saying remain higher for longer because that implied that they were still going to continue to raise rates, which, you know, they've left that on the table. They said they are willing to raise rates still if needed. But the consensus at the moment is they don't need it. They still need to wait and see. So this continues to leave us waiting on data, and that every data point has more impact than it normally would. I feel, you know, a little sense of nostalgia for the days before COVID, before all that helicopter money hit the markets. And then since then, all of the inflation that it caused. If you weren't trading before COVID, then you never experienced that kind of market. A market where we didn't tiptoe around every single data point. We weren't ignoring them, right? But we didn't have to, you know, call a crisis just because we were going to get non-farm payroll numbers, or, you know, CPI was coming out or something like that. It makes it really hard to, you know, develop and run long-term buy and hold portfolios when the markets are so over exaggerating the response of each data point that we get. The good thing is it won't last forever. Nothing does. So green on the screen around the world. The Russell is up the most, nearly 1%. This was a big focal point probably 4 weeks ago, maybe 3 weeks ago. If you remember at the start of the year, a lot of that drive came from small caps. It was like this dash for trash, kind of, you know, short squeeze. And the markets, that started the fire, but then we just kept going for a lot of other things. And there's been some discussion about the Russell being the most beat down of the indexes, and how there's some really great names in there that are, you know, kind of prime pickings if you were to begin bottom fishing some ideas out of it. So all eyes have been on the Russell, kind of looking for that turning point as perhaps a little bit of a signal, you know, for a resumption in this move back to the upside. The thing is, using something like that as a signal or a turning point, it's not solid enough, right? That's too vague, and we want something, you know, cleaner and sharper than that. It's just good to see that small caps are up. Just be careful with those. Short squeezes can be violent, and they can end quickly. Behind that, we've got the UK, and then the NASDAQ in Europe, and then the S&P. Hong Kong holding well at about 0.5%, getting closer to 0.75%. And behind all of that, the Dow Jones, the blue chip. My cat's talking trash. I don't know what the heck she's yelling about. And then Japan. Now, speaking of Japan, we do got data tonight coming out. Pretty big deal. Got a lot of data coming out here. So, you know, think about what you're holding, and I gotta go see what her problem is. What? I don't have to go. She came to me. What? My goodness. So got to keep track of the data coming out of Japan tonight. think about what you're holding, because it could take a serious whiplash. FOMC this week is the biggest thing on the table. So when we go to like Market Watch, it doesn't even have anything listed for today. They didn't see anything on the table to be present enough to be even listed here. So all these smaller ones that we've got going on, the Bank of Canada speaking, we got additional auctions today. We got Dallas Fed manufacturing. So, we got some. They're just not anticipated to be really big deal. But tonight with Japan, that one, especially if you're, trading in the Globex in the futures, if you're trying to trade in the evenings, you really want to be paying attention to what's happening around the world. I generally listen to Bloomberg Asia when I'm trading in the evenings, just to get a feel for how those markets are opening up. All right, so we talked about it last week, how the market was going to end in the lower portion of that weekly candle, and then how we opened up this week would become really important. I gotta say, I would much rather have a gapped down Monday and then a rally up than have a gapped up Monday. And so I'm less bullish now that we've gapped up than I would have been if we had gapped down. One of the things we want to focus on is that 4206. It's 50% of last week's range. It's kind of a really big deal, and it lines us up with the 4211 cog line, which is also the 50-week moving average. So a lot of, we can call it resistance, we can call it unfinished business, just call it Bob's uncle. I don't really care what you call it. Just watch that 4210, 4215 area, right? It's going to be really difficult to get through that zone. And that's if we manage to rally up enough to even get there. One of the things about an FOMC week that we generally try to do, or we try to approach, is that they're going to hold the market steady as we wait on FOMC. That used to be our kind of a go-to base case argument, right? So, it's an FOMC week. We're just going to buy weakness and sell strength and expect a little bit of a megaphone pattern while we wait on the market or while we wait on POW. The thing is, what we've actually started to see in the last 2 quarters or so, maybe 3 quarters, is this kind of a run into it. So it's not what we would expect. All right, let's kind of hunt for some of these FOMC weeks, and it helps to be able to see the week, right? So we'll put on the weekly expected move. That way we can see where the FOMC week was and where it started. All right, so here is an FOMC week. And if we were waiting on the market to sit sideways, then this one worked. Here was Friday's close. Monday, we really didn't do much. Tuesday, same thing. We didn't do much. Wednesday, down we go. All right, so it responded on FOMC day, and we were just kind of holding the range until then. That's what we expect. And it was our base case estimate. When we would come in on a Monday, it's we're just going to hold the range, right? That's kind of the argument. But that's not what we've been getting lately. It's been this single direction drive, and then we get into FOMC, and it either keeps it or it doesn't. But it's no longer just this idea that we'll just hold the range. So here's another one where we closed on a Friday, kind of at the higher end of that zone. And Monday and Tuesday, we had a reasonably decent move all the way down to the edge of the expected move, and then by Wednesday back up again. Just a second. Yeah, I don't know. She's just having issues. It's Halloween or close to it. Maybe she's just seeing ghosts. So same thing, if you look at where we closed on Friday and where we were Tuesday afternoon going into the close, we were right back where we started. Hold the range, wait for FOMC, same argument. Now, this is where things started to change a little bit. Friday into the close. Monday, we took a run towards the edge, didn't make it. Tuesday, we got all the way to the edge. So starting to widen out a little bit and actually start to see some moves. Same thing again here. Friday into the close. By Tuesday, we had passed all the way through the weekly edge. So the whole idea of hurry up and wait is kind of getting set aside. Here's Friday at the close, Monday making a run towards the edge, Tuesday all the way through the edge, and then into Wednesday with FOMC. That one to the upside, the other one to the downside. So there's no precedent to, up or down. Just the hurry up and wait is kind of not following through for us that well, right? That isn't playing out. So while we always tell people, hey, it's an FOMC week, approach with caution, expect lowered volume, don't really expect this market to go anywhere. That's the precedent historically, but there's always the exception to the rules. And what we've seen over the last few FOMCs is that we actually do go somewhere. We go to the edge of the expected move. So let's kind of approach it that way this week as well, keeping to the idea that we could very easily go to one edge or the other, no problem. We've already started in that direction. It doesn't mean that we're going to go to the top side. In those examples that I was just showing, there was more than one example where we started to go down and then we went up, or we started to go up and then we ended up going down. So, don't lean into it like, oh, well, we've started going up, so now we're just going to aim for the upper edge. The idea here is that even though it's FOMC, and even though, or it's FOMC week, and even though we are expecting lighter volume, this market can move. And, it's something that newer traders kind of forget or just don't know yet, is that markets can move farther on lower volume than they can on heavy volume. That might seem counterintuitive if you're newer to trading, but think about the dome, or just think about the bid and the ask and how many are resting on that bid and on that ask. If there's 1,500 contracts on each tick on the way up, then that's a lot of orders that have to be filled before price can move up to the next level. But if it's really thin, like trading on the NASDAQ futures, and there's only 9 contracts per tick, then it wouldn't take very much to drive us through those, right? 100 order block order could come in and move us 4.5 points in the blink of an eye, which happens all the time in the NASDAQ. So lower volume can really see price moves. And, looking at volume this morning at 99, sure, we're coming in a little light compared to the 126 and 155 for an example of last week, but 99 is within our normal range. Getting below, say, 75 or even 65, then we could point to it and say we've got, some much lower volumes. This is just low operating volume at this point, but it's still operating volume. That 4260 zone, we got a 10-day, 30-minute volume profile here. Point of control is still at 4260. We have no classic profile here, right? Normally we'd be looking at a D or a B shape. We have nothing. This is just wadded up bubble gum at this point. There are some shallow areas, but I wouldn't anticipate any value out of them at all. So the only thing that we can really point to here is that the point of control has been moved down from that 4,400. It's at 4,260. And if we continue to maintain this range in the lower half of the weekly range, that 4,206 level that I drew out a little bit ago, If we stay below that 50% mark, then we're going to bring this point of control down to the 41.67 area. So, it's the idea that if we were to try to run up right now and run through that point of control, we'd probably reject there and fail to get through it. But if we spend Monday and Tuesday below this 50% mark, then we're going to bring that point of control down to us. And at that point, we don't have to try to drive through it. We can just rise above it. Big difference between those two things. So on Friday, we did manage to tag that VPOC 41.2375. We're going to take that off this morning, but I wanted to leave it on there just a little bit to show that even though it was an old contract and it was unfinished business from a series that we don't even have anymore, it still was a present, right? That's pretty awesome. Now we've got a new VPOC from Friday. So we've in our drive back up, because eventually we will go back up, we're going to have all these levels to deal with. Now, generally when it comes to VPOCs, the V is for it not being touched yet. And obviously this has been hit. It's no longer valid. It's not a VPOC at this point. Now I'm going to leave it on here because I want to see how price responds around this level, but you wouldn't want to carry this forward if you're only marking VPOCs. It's virgin point of control, untouched point of control. So if your goal is to mark out a VPOC, you would not mark this one. Right now, all I'm doing is just carrying forward the point of control because I want to see how price, if we do go back down this morning, I want to see how price responds around that level. It's just a little something that I've been working on. It just, the textbooks, if you were to go study volume profiles, there's the one that you have on your intraday chart today that you're literally building as trades go through. But then there's how do we use previous days profiles and what do we carry forward? The value area high and low, the point of control, whether they've been hit or not, right? That's what the books tell you, carry them forward. Then there's VPOCs. We haven't hit that yet. And that is a more distinct point of control, has its own rules and conditions. We would carry it forward or not. So, there's no right or wrong here. There is no VPOC for today. There's only yesterday's profile or Friday's profile. My main goal at this point is to watch the flows as we come down into that zone. I want to see if the flows are there. It can tell a little bit of a story. I've got Jigsaw, but Jigsaw, Bookmap, either one, be able to see those flows as we cut through that zone. All right, so we've got the weekly range marked out. That's that 4206. But we do also want to mark out another range. It's yesterday's zone. You can see we're already through the 50% mark. Now it needs to hold it just to kind of demonstrate why holding it matters. If you look at, say, how we responded Thursday into Friday, this is Thursday, the day that we're talking about. There's the 50% mark. So on Friday, we opened, gapped down, we ran up, we got above that 50, but we weren't able to keep it, and we sold back off again. So something to consider, right, is that we can get above that 50% mark and not keep it. Today, we're above Friday's 50% mark. And so far, we're doing really good. We're actually messing with Friday's open right now. That's a key pivot point. So in stages, we've got to get through this Friday's open. Then we've got to get through the 50% mark of Thursday. Then Friday's high, break out of that into Thursday's open, and then Thursday's high. And then we'll focus on this gap close, which also happens to be really close to the weekly expected move top. 42.11, no less. Oh, don't you love it? Those cog lines never cease to give. So one step at a time, one pivot point at a time, all the way back up. And that's if we even continue in this single direction push. These are the 9 sectors that we tend to focus on. The top 3 are risk on, the bottom 3 are risk off, and the 3 in the middle are midline. Tend to do good in a good economy or a bad economy. And if you notice, utilities is the only one over the last 5 days that's green. Everything else is in the red to varying stages. Healthcare was down nearly 4% over a 5-day period. Energy down more than 6.25% over a 5-day period. So the winds of change, right? Now, when I come out to this chart, and I tend to do it a couple times a day, but there's some bigger picture points of view that we want to focus on. The stages of moving averages in price, right? It's a real simple thing. Just at a glance, you get this feel for how's things going out there. A good market, a healthy market, a strong market would be price above the 50 and 50 above the 200. When you have that, you've got a good, strong, healthy, solid market. When price is below the 50 and the 200, and the 50 is below the 200, you've got a full-on bear market with trend, everything is there. So when we're looking at these, take a look at healthcare for an example. The 50 and the 200 just crossed down. So the move has kind of been working its way down there, since August. And then we really fell out of bed here, back at the 1st of October. But we're just finally getting that 50 to 200 cross. Or, building materials. It's been crossed now for half a month. But you look at something like XLE, the 50 and the 200 are still laid out in a bullish stance. We've just got a short-term unhealthy alliance here with price breaking down below both of those. Same thing with tech. It's below the 50, but the 50 is still holding above that 200. So the winds of change, right? Things are definitely changing. Finance, for an example, has that full cross. But until tech actually does get that full cross, then it's just on watch, on alert, right? That we're nearing the edges of too far. There are some good videos over the last 4 or 5 days from Grayson at stockcharts.com, David Keller, same place, Stock Charts. It's free, right? You can download the Stock Charts app, watch it like Stock Charts TV, or you can do it from YouTube. But they're looking at breadth a lot over at Stock Charts. It's a great place to go when you want that broader picture perspective. And their message has pretty much been, we're right on the edge of something going really bad or starting to recover. That's really what this is pointing out. We got the put wall at 41.20. We're still a long ways away from zero gamma. Market's not considered even remotely bullish as long as we're below that zero gamma level. So we got to get above it. The thing is, it would be bullish getting above it, right? We'd have to drive up and break through the previous week's high to get above that zero gamma level, and that would be bullish. It's the vol trigger at 43.20-ish, 43.11. Cog line is just right below it, so it can't be too far away, 43.19. So those are two major optionality levels that are over our head, 4,300, 43.19, previous week's high at 42.90. There's just so much trash to get through overhead. Anything taking this market to the upside, like FOMC, is very likely going to take at least one rejection, right? That it won't be a straight shot. And there's so much work to do to get back up there that, you know, it's going to be a fight. Even if we were to turn around today and start working our way back up, you know, it's not going to happen anytime soon. Think about last October's low and how difficult of a run it was just to get back up to 4,300 from 3,700. That's a 600-point move. It took 2 months with a lot of really big pullbacks along the way. And we haven't turned around yet. There's no promise we're actually going to turn around. We could just keep headed to the downside. That is a consistent, persistent trend. Bitcoin is up 2.8. China ADRs are up 1 3/4, pretty close to that. So semiconductors, China ADRs, Bitcoin products, we got a lot to work with this morning. So with the Bitcoin proxies, Coin, Riot, Mara, maybe not Mara. Mara kind of got whacked on some news, right? That it was like 2 weeks ago. Seems like forever. But we are seeing those Bitcoin proxies moving around. Sure enough, even Mara. So that's a good start. Riot, Mara, Coin. Very likely you're going to get something like Hut and Hive. Yeah, not a lot of flows there yet. I'd leave those two alone. But that gives us the Bitcoin group. Then we've got the China ADRs. So your KWeb constituents. See that KWeb is up when you see that this is up. Want to look at things like Baba, Baidu, PDD, JD. All of those are up this morning as a part of that same group. And semiconductors. So AMD, NVIDIA, SMH really isn't getting much flows. TSM getting a little bit in there. So that's three groups that don't necessarily focus on the Russell itself. Really? Got ARC up, which kind of fits into that short squeeze, you know, beaten down junk, getting squeezed from below. So, you know, looking at ARC is just a proxy, right? We're not looking at this suggesting that that's a good play. It's just, what does ARC represent? In the same way that we would look at the FANGs and open up the FANG index to see what the holdings are, and then ask, well, what in the FANGs are doing good? You would want to do the same thing with ARC, right? And you can Google ARC and you'll get, you know, the holdings that are in it. It's not a secret. And you can see the weight of those holdings, which ones are the top weighted names in ARC. When it's up like this morning, those names that are in there, especially the highest weighted names, are where you want to go, right? That's the direction you want to look, the focus you want to take. So we do have ARC as well up. So semiconductors, China ADRs, Bitcoin proxies, and even this kind of a dash for trash ARC, right? That's a lot of proxies that we've got moving around this morning. Even if the indexes themselves are kind of stalled out and not really doing much. So we're looking at the Dixie, the DXY dollar index here. This is not the dollar. It's a bit like an ETF. So if you think about SPY, SPY has Apple and Microsoft and NVIDIA, right? SPY's got all these names that are in it. This dollar index has dollars from around the world, or, you know, nations from around the world are in it, not just the US dollar. So we call it the dollar, but it's an index. It's just a collection of, right? It's not the real US dollar. But we're above that 106. And sure, we're mildly down this morning, slightly more than 0.1%, but that's not really bearish in the big picture, right? I think anybody that would look at this would say that this is still bullish. Now, sure, we've got a bull flag here, and the longer this bull flag stays paused, the more we would discount the fact that it's a flag at all, right? It can't just stay here and still be considered a flag. At some point, we'll say it's no longer a bull flag. But on the other side of that, the longer that we hold this zone up here, the more likely it is that we're going to continue to go up from here. And you can see from the past, we have been higher than this before. Right. So the idea is, if we're still bullish in the dollar, the market's still got a lot of trouble going on. And that's not a always thing, right? There's been times in history where having the dollar up, the Dixie, up above 110 and 112, and we still had a market making moves to the upside. So it's not some guaranteed thing that when the dollar goes up, the S&P goes down, or that the markets go down. The reason that this is up is why it matters, right? If you remember when China was cracking down on its richer citizens, and they pulled out of their own market and they wanted to get into our market, and they needed a dollar conversion, right? They were buying the heck out of tech with that conversion. And so the higher the dollar went, the higher tech went, and we just had this crazy market with the DXY ripping to the upside, and tech was right behind it. Both were just going higher and higher and higher. So, you know, don't think that it's some, you know, inverse correlated teeter-totter that when this goes up, the markets always go down, because that's not the way it plays. It's just the environment that we're in right now. So we want to continue to see this fade off. We're down just slightly, but slightly is not good enough. We need some convincing. Let's start with breaking through 50% of last week. That'd be a good line in the sand as a starting point. That would be 106.12. If we can cut through that, then we'll focus on the round number, 106 even. Then the low of last week, 105.36, and then on down from there. This is the 30-year bond, still holding those lows. If you want to look a little closer into the front end, here's the 10-year and here's the 5-year. Flip it over and look at an ETF, right? Like say TLT, rather than using the bond futures. Got the bond ETF. We are up this morning a little bit. Or excuse me, we are down a little bit on the week. This is a weekly. So looking at how we closed on Friday and where we're at this morning, still weakness. For everybody who was asking, hey, is it time to buy bonds yet? Not yet. 1 week doesn't mean anything. You can see all these different locations where we had, 1 or 2 weeks, and we've still just been heading to the downside. So bonds are still not safe as a long play. Take a look at the other side of the fence. Rather than looking at bonds, we look at the yields. I've got that 5% marked out. And we closed down on the week pretty good. But here in about 11 minutes, we're going to start to see data this morning. The TNX isn't open yet, so we're not seeing any prints. But we do have things like the 10-year futures. We can see that the 10-year this morning is at 4.89. We are broke out above Friday's high. So we're inside day breakout. Now we want to focus on Thursday's levels. $4.911. And just in case we come back into Friday's levels, let's go ahead and mark out 50% of that too. That'd be like an area of support if we do start to fade back down on the day, or at least a lower target. All right, so with the 10-year heading up like this, our biggest threat right now is what is up with the Dixie. If this starts to go up with that 10-year, then we're going to see the S&P head to the downside, and the NASDAQ too. But we're not seeing that yet. These two are decoupled. You want to watch to see if they reconnect, start to move in sync again, because that's going to be the tell. Right now they're disrupted. They're each doing their own thing, and that's kind of helping us stay afloat this morning. But notice how we've stalled out. Sure, we're holding this high, but we're not really getting anywhere. Just kind of grinding higher highs, higher lows, but it's a grind, and it's not sustainable. So something's going to break. The NASDAQ already gave an equal high, maybe even a lower high, and that's a little bit of a warning, right? So look for the 10-year to head down and start giving us a shape that looks more like the Dixie, or look for the Dixie to break this 106.5 and challenge its own Globex high and start making moves like the 10-year is moving. US dollar Japan is underneath that 150 area, which is a good start. US dollar Japan is our tell for Bank of Japan intervention. It's one of the few things that could really pull this market out of a tailspin if we do really start going to the downside. But there's no indication yet that they're going to use that, right? I think that's going to be a little plunge protection, wink, wink, nod, save it for a ripcord scenario. And right now they don't need the ripcord. Keep your eye on bonds breaking below Friday's low. And otherwise, I mean, these are the ones that you're really going to want to lean on today. As long as this dollar remains stale, stagnant, it doesn't have to continue to fall. It just can't rise. That's really important, right? So, it can just hold this low here, chop about, really not do anything on the day. I think we could continue to see the semiconductors and Bitcoin plays. I think they could do okay. It won't be fantastic, but it'll be okay. If the dollar breaks lows and really starts stretching to the downside, then this move up could really, we could get to the edge of the expected move on the top side today if this dollar breaks down. And for the 10-year, not moving would help, but that's not what we've got. So watch for this play. We kind of have it setting up now. Look for the 10-year to get into the 50% and reject there to the downside. That would be a really nice play on the S&P with a breakout shot. So we want to see where's the S&P as the 10-year gets into that 4.91. It's very likely that we're going to see the S&P back down along this Globex shelf here around that 41.54, or maybe even back to 41.43. So that would be looking for a bounce back up in the S&P after a rejection in the TNX if we get it. Because if it breaks through that 49.11, we're very likely going to break this low, get that gap closed, and start challenging yesterday's low. The bonds are trying to help out here too. We've already got the 10-year breaking out, and we got the bonds trying not to break out. They just did break out, but they're fighting it, trying to get back up inside of yesterday's zone. So remember, these two move very closely together, right? They're not perfect lockstep, but if the TNX's inside day breakout to the upside, we would expect the ZB to inside breakout to the downside. And it's really trying to get back inside the zone. If it does, then we're going to expect the TNX to have a harder time getting up to that 4.911 level, let alone get through it. All right, so I think you guys are pretty well lined up. Semiconductors, Bitcoin proxies, China ADRs. That's a solid list of 3 different areas for names to trade, plays to take to the upside, or to, yeah, mostly for the upside. Keep in mind too, if they do start to sell this market off, those things that are up the most will be fantastic shorts, right? You don't want to sell things that are already down on the day 2%. You want to sell things that are up on the day 2% if they start to sell this sucker off. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.